infrastructure plays a critical role in facilitating the development of many of the largest structural trends underway within society today. For example, assets directly or indirectly involved in the generation or transmission of electricity as part of the energy transition, or assets enabling the exponential growth in the production and movement of data around the world as digitalisation spreads ever further through industry. Today we'll discuss some of the investment opportunities presenting itself through the ownership of critical infrastructure in these and other associated areas. Hello and welcome to the Investor Insights podcast, hosted by Killik Co. My name is Gordon Smith, and in each episode, I'll be interviewing portfolio managers from across the investment industry to gain from their expertise in the specialist areas in which they invest, and to question them on the topical issues of today. Killik Co is an independently owned wealth manager which opened its first office in 1989 and provides services to help families save, plan and invest. And you can find more details of the unique ways in which we do that on our website, killik.com. In this episode, we were joined by James Dawes, Chief Financial Officer of 3i Infrastructure, or 3IN, a company he joined back in 2016. 3i Infrastructure is a London main market listed investment trust with a market capitalisation just shy of £3 billion. Infrastructure can come in lots of different forms and the return profile can differ markedly. 3IN, within this portfolio, is taking controlling stakes in private operating businesses within the infrastructure sector, an area of the market which includes what we would term economic infrastructure companies. This is an important distinction when compared to investing in other forms of infrastructure assets, such as finite life concessions or those strictly regulated monopolies, which don't tend to feature in the 3i strategy. A typical 3IN portfolio constituent may carry a slightly higher risk-return profile to some other infrastructure investments, but typical investments exhibit some important characteristics which give them notable attractions from a long-term investment perspective. Typical holdings will tend to have a strong market position within asset-intensive industries. They'll have an asset base which is hard to replicate and that they own in perpetuity. They'll also have opportunities for further growth through exploring additional markets or expanding utilisation. And these companies will also share the classic characteristics of infrastructure. They'll operate within regulatory frameworks or provide essential services. And through this, they'll tend to generate stable and predictable cash flows underpinned by long-term contracts. The listed infrastructure sector has had to adjust to a significant shift in interest rates over the last 2 years. The expectation and realisation of widening discount rates used to value these portfolios has been a clear headwind. The market implied value for these investments will continue to remain sensitive to economic forecasts and particularly to long-term real yields, those being the annualised fixed income return after an adjustment for expected inflation. However, with real yields having moved sharply higher and into positive territory, real assets such as infrastructure priced off these heightened yields should provide the opportunity to lock in attractive long-term returns to investors. James, good morning. How are you today?
Good morning. I'm very well, thank you, Gordon.
So the first question that we've been asking in this kind of series of discussions is one that kind of tries to get to know you a bit better in your kind of typical working week. So I wondered if there are any kind of anecdotes that you'd share from perhaps recent company meetings or research trips, or even just a kind of interesting article or book that you've been reading recently. Was there anything you'd highlight there?
Yeah. Okay. So I'm the CFO for infrastructure at 3i. So most of my time is spent doing CFO stuff, and that includes doing conversations like this, but also seeing investors, talking to lenders, and indeed some portfolio management work. In terms of what we're up to at the moment, so we're in early March now, so we are getting into our busy our busy part of the year. We have a March year end. We look carefully at our valuations of our portfolio companies at this time of year, and then we get into writing an almost 200-page annual report, which we get out in about 5 weeks. So it's pretty full on. In terms of things that a book I've just read, I've just finished reading The Coming Wave, which is a book on AI by Mustafa Suleiman. He's a Brit, but working mainly in the States, I believe. And something about the sort of potential, but also the risks. He's fairly downbeat on the risks of AI, but we think quite a lot about AI in terms of it as an opportunity for our digitalization megatrend. I'm sure we'll talk more about megatrends and that sort of thing later on.
Good stuff. Yeah, I actually read The Coming Wave over Christmas, actually, so I'd also recommend that. But
yeah,
you're right. It does focus a lot on the kind of negatives, but there's an awful lot in kind of touching on things like synthetic biology, which made me kind of think about some of those other areas. Yeah, fascinating. Fascinating kind of changes happening in biology. So yeah, I'd also recommend that. But perhaps moving on to the 3i portfolio itself, infrastructure has clearly kind of got a huge part to play in a number of the kind of major structural trends that are underway within the global economy. You kind of think about energy transition or resource scarcity or digitalization, AI as well being a clear one. Can you maybe talk us through some of those areas that the 3i portfolio is currently exposed? What would you kind of highlight as being kind of those big themes that are played in this portfolio?
Yeah, so we think a lot about megatrends, both in sort of selecting investments and how we manage the portfolio companies that we have in the portfolio. I mean, the two largest trends within our current portfolio, we've got 12 companies in 3i Infrastructure at the moment, are the energy transition, but in lots of different ways. So I can talk a bit about how we're playing that theme, and digitalization, which I mentioned earlier. Again, a number of different ways of playing that theme. So, I mean, I think over the next couple of decades, those are two areas where there's going to be a huge amount of investment required, obviously, to decarbonize our energy sources and to cope with things like whether it's cloud computing, which is a recent push for digitalization, but then AI could even be bigger than cloud computing when it's really taking off. So those are two things. I mean, we like to have a balance of risks within the portfolio, so we won't do everything in the same way. We don't want too much power price exposure, for example. We're not a renewables fund. We're trying to take we're trying to build a diverse portfolio of different companies and different risks. So we've got a vessels business that owns and operates wind farm maintenance vessels in the North Sea and now over in the East Coast of the US. So as more wind farms need to be built, we're not investing in the wind farms. Other people are doing that, but we are owning the vessels that have long-term contracts with people who are maintaining the wind farms. And that's good quality inflation-linked revenue for owning and so essentially renting out those vessels.
Yeah, good stuff. Yeah, that kind of summarises the portfolio well. So we just had a kind of an update meeting with you. We kind of ran through actually most of the portfolio holdings. Actually, it was a really useful meeting. One of the key kind of takeaways that we had as a team from that kind of discussion was the growth opportunities that are present within many parts of the portfolio holdings. And you can, I guess, the kind of risk spectrum of infrastructure assets. We often talk about there is a kind of a wide spread of, like, from kind of fairly low risk contractual payments right up to kind of higher risk operational businesses. But it was the kind of growth that was present in a number of those holdings, and also the strength of the contractual income when we're kind of talking through some of those company holdings. Can I maybe ask you to pick up on maybe one or two of those case studies just to exemplify those features as you did in that recent meeting?
Yeah, I mean, so we've talked about this a lot in the past, the infrastructure market in the listed space. So what your end investors can purchase does have a range of different types of investment company in it. Some are predominantly investing in concessions, so roads, hospitals, schools, and so on. So that's long-term contractual income, might last 30 years. And you know what you're getting, but there's no growth there. we only invest in real businesses, in companies with employees, with strategies and growth. And so that we think we're unique in the market, having a diverse portfolio of real companies. Our largest company, TCR, is a good example. It's it owns and leases ground handling equipment to airlines, ground handlers, and airports. So if you think you're boarding a plane, all the equipment that is around the plane is the sort of thing that TCR will own and lease. It might be to Swissport or Menzies as ground handlers, or it might be to I know Finnair as or SAS as sort of airline type customers. And what's in it for the customers? Well, they don't have to own the kit. If they've got a contract that maybe is 5 years long to run the ground handling operation, then why would they buy kit that lasts 15 years to service a 5-year contract when they can lease it for the 5 years from TCR, and TCR will provide it on a fully maintained availability based lease, so contracted revenue. But at the end of their contract, if they don't win the contract, then whoever does win it can then continue to lease the equipment from TCR. So it's one of those things. When we first invested in 2016, we spent a lot of time looking at sort of contract underpin and the renewal rate of contracts, and it's very, very high. So over 90% of renewal for the contracts, but it's only sort of 4 or 5 year contract. So, but it appears as a very, very high quality revenue stream. And you were talking about growth opportunities since COVID. It's been doing very well. So the customers, generally speaking, had a tough COVID. Obviously, the air travel industry largely shut down for a period of time. They obviously all anticipated that they would start flying again. Then we're going to need the kit, so they didn't give up on the kit, so that it was ready when they started flying again. But interest rates have gone up. They're more concerned about the strength of their balance sheet, so they're less inclined to incur the capex themselves to buy these pieces of kit, and they're more inclined to rent it from TCR. So we're seeing lots of opportunity for new contracts there.
Yeah, I mean, I personally think the attractions of that equipment rental sector have taken a bit of a step change as interest rates and borrowing costs have moved higher. You can certainly see how businesses which are more constrained by the ability to raise capital now, you can see how companies like TCR will now play an important role in continuing to allow companies, in this case in the air travel industry, to continue to improve efficiency or scale up against that backdrop of tighter financial conditions. Yeah, we can certainly see that. I mean, we have clearly experienced a pretty significant change in inflation and interest rates over the last couple of years. Could you maybe kind of talk us through any steps that you've taken with the portfolio or at the investment company level against that change in environment? I don't know whether it might be kind of management of debt or changes in the capital allocation policy that you've made, or perhaps run us through those characteristics of the portfolio which are kind of helping to withstand that new economic environment.
I think there are two key elements to this. There's what we've done in terms of portfolio company financing, but also the way it's impacted the investment company itself when the interest rate cycle changed. So obviously when rates were near zero, we very proactively over a number of years refinanced all of our portfolio companies, such that at the moment, and this was in our half year results published in November, the weighted average cost of debt is just over 4%, 4.1%. So clearly that's very low interest rates plus a margin, and overall sort of about over 90%, maybe 95% of the debt is fixed rate. So we locked it in, and at these low rates. Overall, we're not over geared. That's the other thing you don't want to get wrong as interest rate cycles turn and debt starts costing a lot more is to have too much debt, and we think we're relatively conservative in our approach to gearing. We aim for sort of investment grade quantum and tenor, for example. So we're about 34% on average loan to value. So not too much debt at portfolio company level, and we've got ample headroom to covenants. So when the debt market changed, we were ready for it. For high quality infrastructure companies, lenders are still lending. So other parts of the debt markets shut down or took a step back. Whereas in our part of the market, you can still get debt. So whenever we come up to refinancing, and I mean, I won't go into it in detail, but we do publish when the debt falls due, and there's not much really over the next few years. There's a lump that falls due in 2030, which is a pretty long way out, and hopefully interest rate cycles are changing in the other direction now. So that's at the portfolio company level. For 3i Infrastructure itself, and this has affected all of the infrastructure listed companies, including the renewable energy companies. We all traded for a very long time at a premium to net asset value. When interest rates went up, somewhere between when we got to between 3 and 4%, I think, for the base rates, we all moved from trading at a premium to trading at a discount to net asset value, which is where a lot of our investment trusts typically trade. I'm pleased to say that 3i Infrastructure trades at the lowest discount in the sector, and I think that might go back to the growth. You know, we are a different animal, and the growth in the portfolio, so we're viewed differently from other companies. But anyway, so we've moved to a discount, and what that means is over the last year or two, really the growth in net asset value that we've been generating has not flowed through to growth in the share price. We've been paying out dividends, so people have got that element of return. But I think as the interest rate type cycle is probably at the top, or maybe start soon changing direction. What I'd like to see is the growth in net asset value then actually flowing through to share price. And obviously, if the discount narrowed, that would be or even moved to a premium, that'd be a benefit on top of that.
Yeah, we can't really not talk about valuations when it comes to infrastructure. I wonder if I could maybe ask another question on that. I mean, one of the things that we've seen, as you inferred, 3i Infrastructure is doing something quite different to a number of the other investment companies on the London market. One of the other things that we've seen in recent years, kind of supporting that 3IN portfolio valuation, is the sale of holdings, often at premiums to the holding valuations. I guess that kind of maybe evidences the kind of the attraction of these types of assets to strategic buyers or institutional investors. Would you have any general observations about that and kind of current valuations of the portfolio itself?
Yeah, that is a theme of what we do. We will sell assets. So I always say it's selling the right company at the right time and the right way, through a competitive process. But so that has always been a feature of 3IN. And then we recycle that sort of proceeds from those realizations into other either new investments or growth through the existing portfolio. So we sold a business, Atero, which is a large European waste treatment business, at a range of things that it did, including energy from waste, so incineration, but also recycling, landfill, anaerobic digestion, composting. It did really a bit of everything, based in the Netherlands. And we'd owned that for about 5 years. We delivered our business plan in that time. We doubled EBITDA, and we thought it's time to refresh the business plan. Working with advisors, came up with a new plan, which would have required a lot of capex. I think it was about €1 billion of new capex, largely about new anaerobic digestion facilities, that sort of thing, and carbon capture and storage. So we thought actually it was better for somebody else to fund that capex. So we thought we'd done a lot with the business. It was time to try and sell us on to somebody else. So we did that. It took a lot of time preparing the business for sale, then running a competitive process. And when we sold it, we sold it for a bit over 30% more. This is in last July, 30% more than we'd valued it at last March. So we would expect to see uplifts on realization. You should get a pickup when you actually take something to market and run a competitive process versus a buy and hold fair value, which is what I think we hold things at in the portfolio. But the good thing is transactions like that, it's a proper third-party transaction, does validate where we are valuing our assets. And we valued Atera in exactly the same way as we value everything else in the portfolio.
Yeah, absolutely. And that provides a lot of support to those published figures for sure. One thing that I think is kind of good to get across is we've kind of talked about the kind of different the kind of range of the risk spectrum of infrastructure, but there's also different degrees of private equity ownership or ownership of these types of assets in terms of how involved the management team are with their companies. And I mean, it is clear if the 3IN approach isn't just one of kind of simple ownership. You're often taking board seats of these companies and being pretty active. I wondered if you could talk us through some examples of just how involved you are with these underlying portfolio holdings. I mean, it's a relatively concentrated portfolio. You kind of talk us through kind of how you're getting involved with those board seats and involved in kind of strategy and the direction of travel.
Yeah, I mean that's absolutely right. We're part of the manager. We're part of 3i Group. We do everything in a very private equity way, which I think is a good thing. It's a very active way of managing the assets. We're on the board of all of the portfolio companies actually, and control the boards for almost all of them. So we're very involved in setting strategy. We're in contact with management constantly. Typically it's monthly board meetings, but there'll be conversations on a weekly basis. We'll have working groups with the finance teams, for example, often on a weekly basis. So we spend a lot of time with management. We go and see them. We're with them for the board meetings typically. And we're involved in some setting strategy. So you're after some examples. So SVAC, which I mentioned earlier, the vessels business, Danish business, predominantly operating in the North Sea. When we bought it, it was mostly servicing, the vessels were mostly servicing offshore oil and gas platforms. It was carved out from Maersk. So we had to sort of set it up as a standalone business. We've recruited a number of members of the senior management team, including CEO, CFO, chair. So, we do a lot of work with management and supplementing management where we need additional skills or capabilities. And that was, so is it, I don't know, 80 to 90% oil and gas at the time. And then there was a smaller part of the business, 10 to 20% servicing the offshore wind. We decided with the management team that strategically the thing to do was a full pivot to the offshore wind industry as the customer base. So we haven't built any more vessels for the offshore oil and gas side. And what those vessels are doing, they're emergency rescue response vessels. So the vessels circle the platforms, in a field. And if anything goes wrong, hopefully it doesn't, but if it does, they're there and they might have a hospital on board firefighting, that sort of thing. Or if anybody falls off a rig or a supply vessel, they can rescue them. So that was most of the business. I mentioned the wind farm maintenance side. So that pivot has changed from 10 to 20% to around about 70 to 80% now. So over our course of our ownership, we've really transformed the business, changed it. It's longer term contracts for the offshore wind, so it's better quality revenues. It's inflation linked. Early in the life of our ownership, the oil and gas side did struggle a bit. That changed when Russia invaded Ukraine, and there was much more focus on security of supply in the North Sea. And actually that side of the business is performing as well as it has done at any point in our ownership at the moment. But the thesis remains that the cash generated on that side of the business is being deployed in CapEx on the offshore wind side of the business. So that's a fundamental strategic change, and we were working with management to drive that change.
Yeah, no, good example. our kind of standard final question is perhaps the trickiest one. In that we ask kind of you to highlight your kind of highest conviction area of investments. And I mean, I'm not asking you to kind of maybe pick your favorite holding or choose your favorite, but I mean, is there, if there was kind of one particular area of infrastructure or even it could be a company that you have particularly high conviction in over the next few years and beyond, what would you pick there?
So I mentioned that the two mega trends, so the energy transition and digitalization. If I'm going to pick one, I'm going to go with digitalization. And the reason for that is it's very hard to predict power prices. And as I mentioned, we don't want to have too much power price exposure in the portfolio, and it's less than 10%. We've got a sort of rule of thumb. We don't want to go above 10%. My guess is about 8% at the moment. Whereas digitalization, it's about renting bandwidth, renting capacity to people. And we've got a number of different portfolio companies that play that trend. Global Cloud Exchange is a very large subsea fiber network around the world. It includes what used to be known as the fiber optic link around the globe, or FLAG. And that's really talking about shifting large amounts of data between countries and continents. And the sorts of customers you'll be dealing with there are, Meta or Google or national telecom companies. So I think that, that is only going to increase the volume of data going around the world. That is only going to increase. Lots of people will be looking to build more fiber. It does take a while. The CapEx requirements are quite large, so I'd expect that to be sort of in partnership, and hopefully we will take part in some of that. Our investment case doesn't require us to, but it would be good to take part in some of that. But I think the growth in demand is going to be so strong, it will at least match the supply. So I would say that's my highest conviction investment area.
Yeah, that makes complete sense. James, thank you so much. It's been really interesting to talk to you as always. But appreciate your time. Thank you.
Great. Thanks a lot, Gordon.
Thank you for listening to the Investor Insights podcast. You can contact info@killik.com, referencing the podcast for more information on any of the topics discussed, or for further details on the services offered by Killik Co. This podcast is not personal advice. The content is intended for educational purposes only and is not investment research or a recommendation to buy or sell any financial instrument or product, or to adopt any investment strategy. The value of your investments can rise as well as fall, and you could get back less than you invested. Past performance is not a guide to future performance. The investments referred to in this podcast may not be suitable for all investors, and you should seek advice from a qualified investment advisor. Killik Co is authorised and regulated by the Financial Conduct Authority, the FCA.